Hi and welcome to the April Mortgage Market Update. My name is Richard Pennell. We are from the Mortgage Home and we are buy-to-let mortgage experts. So let's get straight on to what's been catching my eye for April 2022. Well, as usual, and still very much in the topic of discussion is the Bank of England. So since we last spoke, rates did rise to 0.75% back in March. And of course, the question many landlords are asking me is, will it increase further? What's going to happen next? Well, I would say the probability is that rates will increase again. That's my personal view on things. Back in March, the majority, I think 8 out of the 9 committee members at the Bank of England wanted an increase to 0.75. And the primary reason is to do with inflation and to trying to counter the effects of the inflationary pressures. Now then, inflation, I think, was at 6%. Today, we're on the 12th of April. We are up at 7%, and the Bank of England are suggesting or projecting that inflation will go beyond 8% before it comes back down. The target has not been reassessed. They still are working on with the government to get inflation back down to their 2%. So that target has not sort of changed. So this may well be a short, medium-term spike as we stand. So do expect rates to increase. What's the one tip you can take from this? Well, if you have mortgages that are locked in at the moment, and they're not due to expire until towards the end of the year, even if that is October or November 2022, then speak to your broker now, because if they can lock into a new deal using April mortgage rates, then you can then sit on that for up to 6 months. Then your product expires in October, November, and you've got your April 22 rates rather than waiting until autumn and then choosing the mortgage rates at that time, which are likely to be quite a bit higher, particularly if you get your mortgages from the high street, because rates are absolutely going up. The Bank of England rate rises are being passed on where the banks are concerned. If you get your buy-to-let mortgages from non-bank lenders, then we can relax a little bit more. They do not get their wholesale money from the Bank of England, so therefore they're not subject to those same direct pressures that the banks are under. So a tale of two halves there. A few lenders I want to highlight this month. Keystone, if you're a portfolio landlord, you may well have heard them. They've been around a good 20 years. They only lend to landlords. Now they've expanded their portfolio limits. I thought it was a good time to just expand a little on what that means, because if you're looking to build your portfolio, as many landlords are at the moment, I do get asked, will lenders keep lending to me when I'm wanting to get my 3rd, 4th, 5th, go beyond 10? You know, how do lenders treat you? Because surely I'm taking on a lot of mortgages here. Well, the message here is to absolutely relax in knowing that as long as you are being mortgage ready, keeping up with your payments, there's no skeletons in the cupboard, then lenders are quite comfortable to lend to you. So in Keystone's example, they would lend until the last week or so up to £3 million. And now they've extended that to a £10 million loan limit. So to turn that into houses and roofs, if you get a mortgage of, say £100,000 for your property that you're buying, well, that allows you to get 100 mortgages. So I've only got 2 clients that have more than 100 mortgages in their or property in their portfolio. So I think for the vast majority of us, that's not an issue. What else has caught my eye? Skipton Building Society. Now they've increased the minimum valuation requirement for their buy-to-let mortgages. So it was 50,000 and now it's gone to 75,000. Now I find that particularly interesting because that's a particular market where if you're buying a property or let's say you bought a property for cash and you want to refinance it and its value is, well, first of all, under 50,000, you just can't get a mortgage at all. So take that message away with you. Do not be buying cheap properties for cash. And I do see them out there, particularly up in the northeast and up in Scotland, where you could buy a buy-to-let for £40,000, for example, and the yields could be 10 to 15%. It does look really attractive, but you're going to have your cash locked up there, because if they're valued under 50k, you're not getting your money back out. Now let's look at that next level, 50k to 75k. As we've just said, Skipton have come out of that market. I had a little look today. There's only about 4 or 5 lenders that will lend to you if the value of your buy-to-let property is under £75,000. So again, the tip here, if you're buying, be looking at properties over 75k. Finally, on this point, only because I got a query in today from an expat client of ours, and he was looking at buying under 75,000. If you're an expat, literally one lender out there at the moment lending if the value of your property is under 75,000. So really raise those sights, look at the properties that are certainly over 75k. If they're over 100k, that pretty much brings every lender in, but a lot will lend to you as long as the valuation is over 75,000. Let's move on to Habito. Now, I've not really talked about them on our mortgage updates. They're fairly new. They've been around for about 5 to 6 years. Initially came in just selling to consumers, and in the last couple of years, they've now opened their doors to us as intermediaries, which is always welcome. It's another lender for us to look at. And given they're so new to the intermediary market, usually I find that these lenders will just dip their toes. But this lender caught my eye because they've gone straight in and they're offering mortgages up to 85% loan to value. Now, they're in a select group of lenders already if they're doing that. Let me give you an idea. You probably all know that the vast majority of lenders will lend up to 75% loan to value, assuming we can tick other boxes and the rental yield is strong enough, etc. Above 75% to 80% in that little bracket, that next 5%, we've got about 20 lenders. Above 80% to 85%, we now have, with Habito joining this pack, about 5 lenders. You know, this number does vary by ones or twos each week, a month, but you get the idea that, that it's a really small group of lenders at 85%. And if we look back, let's say a year ago, that number would be 85% one lender and 80% maybe 4 or 5 lenders. So you can see, and maybe the message you can take from this is that lenders are feeling far more confident and comfortable about the property market generally. Now we're out of Brexit. Now the pandemic appears to have really settled down. They don't see on the horizon any real reason, except for a third world war, you know, who knows. But at the moment, they don't expect any major external factors that would rock the UK property market. So hence, the more lenders are joining at that higher LTV limit, LTV limit 80 and 85%. What do rates look like? Well, Habito's rates 4.5%. If you want to borrow at 85% loan to value, that might be good for you if you're really struggling with cash or want to keep that cash flow in your pocket. Then, you know, 4.5%, that might absolutely suit your purpose. Vida, another non-bank lender, they've caught my eye. Now, they've described this particular product as a special edition. What that means to you and I is it's limited funds. It ain't going to be around for long. So the deal is it's a 5-year fixed at 3.39. So that the rate itself doesn't sound overly attractive. It's, you know, middle of the road in terms of a rate. However, it's got no fees. Now, usually you find at that sort of an interest rate on a 5-year fixed that there'd be possibly £1,000 to, you know, pound arrangement fee, or indeed it might even be a 2% of the borrowing arrangement fee. You know, if you're borrowing 100 grand, that's a £2,000 arrangement fee. So this one's got 0 and a free valuation on their remortgages. And it's also available on HMOs and multi-unit blocks, which usually, frankly, gives lenders an excuse to charge even more. So good on you, Vida. I think that's a decent 5-year fixed. Finally, on the market watch here, always looking at holiday lets. There's always, and indeed, increasing demand from our landlords for holiday lets. But now, finally, talking about the expansion of the LTV limits, as I mentioned with Habito. And by the way, that expansion I mentioned when we're talking about the number of lenders at 80 and 85%, that's just for family lets, long-term family lets I was looking at there. But here we're now seeing a couple of lenders, only 2 lenders that are now lending on holiday lets to 80%. Because there's only 2, they are small building societies, so knowing them reasonably well, there is likely to be hoops to jump through. But again, look, if you're a landlord tight for cash or wanting to keep that cash in the pocket, then do talk to us. You never know, it might just suit you, and keeping that extra 5% deposit in your pocket. Holiday lets, again, I want to talk about it now because we're coming into spring and soon the summer market, and we are getting inquiries every single day, multiple inquiries from our landlords about holiday lets. So I thought it was worth revisiting this area and just maybe talking to you guys who have not thought about it before. Maybe you've always thought about the more safe, in your mind, the perception is that, you know, long-term family lets are the safe option. And absolutely, long-term, really solid, great demand, lots of properties out there. So there's always been a good, strong market, and there always will be, of course, for long family lets. The private rental sector, you know, is always, I'm sure, will be a huge market out there. However, profits on these long-term lets have been squeezed for lots of reasons. Section 24 being the probably one of the biggest ones, as well as more regulation coming in. And of course, Section 24 is fully implemented now. It came in 2016, 2017. So the full impact of the reduced mortgage interest expenses that you can now claim and offset is fully in place. And so I'm sure we're all being hit by that. So hence, more landlords are now looking to either their existing portfolio and say, look, are any of these in the right areas we can use as holiday lets? Are they in touristy areas, or indeed serviced accommodation? Are we near businesses or commercial industrial sectors where perhaps workers or professional people, tradespeople, you know, might want to come in and either rent a room or indeed rent the whole unit? And so holiday lets as a generic title is now becoming far more popular. So not only are the yields considerably higher than the long-term family let, but I just want to focus a little on some of the tax benefits. Now, before I get into that, I've got to say I'm not a practicing accountant. I'm not giving you tax advice. So anything I'm saying here is just for your personal information. Do speak to your property tax account before acting on any advice you get. But some comments from me around tax. First thing is, it's outside of Section 24. So it's not subject to those strict draconian penalties that the HMRC brought in for all those landlords on family let. So you can offset 100% of your mortgage interest when it comes to a holiday let. So that's great news. Also, if you get a holiday let, HMRC and the local council deem it a business, unlike a family buy-to-let. Now, as long as it's a furnished holiday let and it's let out for so many days a year, they've got to tick those boxes. But, you know, we are talking about a proper holiday let. You're not living there part of the year. It's not a holiday home. It's a true holiday let bought for commercial reasons. Then, rather than paying council tax on that property, you would actually pay business rates. But now that you would pay business rates, you can apply potentially for small business rate relief, which, as long as you meet that criteria for the relief, you actually don't pay any business rates at all. So that's a fantastic saving for your holiday let. So that's another saving. The last one, now that I've said this last one, it's a fantastic opportunity. Something called capital allowances. Now we are getting a bit geeky. We're getting into sort of real tax speak here. So the best way is to give you an example of what I mean by capital allowances and how you can use it to reduce your tax that you pay on your profits. So here's an example. You buy a holiday let and it's £400,000. Because the HMRC deemed that holiday let as a business, then they say that you can, with expert advice, so you'd need a quantity surveyor to come in and do a report that puts a value on what we call plant and machinery. And you think, well, that is a very commercial, industrial type terminology. Bear with me. In this scenario, for a holiday let, the plant and machinery means things like the fabric of the property. It means the electrics. It means the plumbing. It means the fixtures and the fittings. It means the furniture. So at the point of purchase, a specialist QS, quantity surveyor, can say, okay, yes, you paid 400,000 for that property, of which they may calculate £120,000 of that accounts for the things I've just described that are already there. And the £120,000 then can essentially be offset as a one-off expense against your profits. So let's say that you get your holiday let up and running and the annual profits are £30,000 per annum on your holiday let. If you've got £120,000, what looks like a paper expense now can come off your profit and loss account. That means you pay no tax in year one on 30 grand. You make 30 grand profit in year two, you pay no tax in year two. You pay no tax in year three, and you pay no tax in year four. Then your 120 grand has been spent, and in year five, you go on to pay taxes on your profits. If you're a high rate taxpayer on 30 grand and you would have paid 40% tax, that's £12,000 of tax saved per year just because you knew about capital allowances. And I want to make another point here. Not many accountants know about capital allowances. Do not expect your accountant to necessarily point that out to you in the first place. I know many accountants that are not up to speed on this. So talk to us about it. If you're any landlord that are known to us anyway, work with us, you're thinking of buying holiday lets, we'll bring it in the conversation if you don't, because it's a massive, massive saving. I think I've got the message across. Let's carry on. Finally, as always, I talk a little bit about insurance. You know, as a company, we offer our clients advice on anything to do with life insurance and indeed income protection. And then that's what I want to focus on this month. I talked about inflation right at the start. It's obviously running away right now. Energy price increases, transport cost increases, just raw material prices going through the roof. And it's having a real impact on our lifestyle and day-to-day lives as it is. That's when you're working. So what if you have that accident? What if you are sick and you can't work? Well, that's fine if you've got a great sick pay scheme with your employer. If your employer pays you full pay for a number of weeks, a number of months, then of course you've got that built-in safety net. But I know many of our clients who are employed are working for small employers who don't offer any full sick pay scheme. In fact, you go straight away, if you're on sick, onto statutory sick pay, which if you look on the bottom bullet point, is a maximum of £99 a week. So if that was you and you're on sick, can't work, and you jump straight onto statutory sick pay, really, genuinely, seriously, ask yourself the question, how long could I last on statutory sick pay on £100 a week? Do I have savings? How long would my savings last? And if that worries you when you walk yourself through that scenario, then income protection should absolutely be something you should be considering. By the way, as it says here, it's not just for people who are employed. If you're self-employed, if you're a sole trader partnership, then you can get income protection to cover your profits. So in the same way that if you think your profits are going to drop because you're a one-man band, if you're not working, you're not earning, then income protection can be available for you. It can pay up to 65% of your gross income. So you know, if I can go back to the employed scenario, if you're on £20,000 salary before tax, you probably come out with about 75% of that, you know, depending on what deductions, of course, that you have. So if you can get income protection up to 65%, then that's a big chunk of your take-home pay that you can protect yourself. And so, you know, in these times more than ever, I do urge our clients to consider it if they've not done it before. Talk to Yvonne, who's our insurance specialist. We make no charge for the advice, putting things in place. There's no fees at all. All our advice is free. And so, yeah, avail yourself of that. Have a chat with Yvonne if you are concerned about that. To bring it to a close, as usual, just to remind our viewers of the various services that we offer. As you can see there, quite a long list, won't go through it, but it does move from the commercial, semi-commercial, right through to the residential, which include buy-to-let within that. If anyone feels that they want to have a chat with any of the team members about anything that we've just discussed on this video, then just cut and paste or copy and paste that link, and you'll get access to our diary, and you can book an appointment. We are really busy. We are really getting booked up. We're you know, maybe 1 or 2 weeks ahead here, so booking early. If it is really urgent, do ring us. For example, if you've had an offer accepted on a property, clearly you can't be waiting 1 to 2 weeks. We can prioritize those people that need to get some mortgage advice that little bit quicker. But if it's a general review, then book an appointment in, speak to the team, get a bit more information, and hopefully we can help, whether it's mortgages, life insurance, or income protection. If you've enjoyed the video, look, I'd love it if you shared it. Do like or subscribe so that you kept abreast of any other videos that we do put out there. Put your comments on there about any topics that you'd like us to cover in the future, or any comments that you've had about the video today. I'd be delighted to hear from you. Other than that, stay safe, keep well, and hopefully we'll see you on the May mortgage review.